I'm just asking for a comment to those 5 oil companies, exploration production companies I've just mentioned.
Could you say them again, please, and speak up?
I have investments in Devon, ConocoPhillips, Anadarko, Apache. I don't have any money in SU, the Canadian company, and I just want to see his take on that.
Well, those companies that you have money in are 50-50 gas and oil, or a little bit higher than 50-50 gas and oil. And SU is actually about 90% oil and 92% oil and maybe 8% gas. So it's very much attuned to the oil side of the equation. If you wanted gas in North America and you wanted oil too, the natural one would be in Ghana, which is in the gas area our number 1 choice, and in the oil area our number 1 choice too. So it would be perfect because it has the largest pipeline system, it has one of the largest production systems, and it also has, and this is terribly important, the number 1 position in land, about 27 million acres in North America of potential land. And as you well know, land is running short. Good potential drilling land is running short, and they're able to high grade their work each year and come up with some drilling sites that are really outstanding, and will be able to do that with that land position for many, many years. CNQ, Canadian Natural Resources, would be next after Encana in gas production, where it would probably be about 40% gas, 60% oil. So you really have a good chance there. In the case of Encana, it's about, at the moment, it's about 80% gas, and it'll go to 50-50 in the next 10 years. In the case of Canadian Natural Resources, it's about 50% gas now, and 60% gas now, and 40% oil. And so if you like gas, and I do, but I think that for the next few years, it's just obvious to me that the gas price is going to expand. I think the oil price is expanding faster than the gas price. And the higher return story will be in oil-oriented companies rather than gas, and that would seem to push us towards Suncor.
Yes.
Okay, me? Okay. Hi, I'm Doug Reynolds, University of Alaska Fairbanks. I did an analysis on the former Soviet Union, that the fact that the former Soviet Union actually fell because of a peak oil event, not because of the Reagan military myth. But anyway, I was there in Russia in '81, and it was a quite robust economy at a lower level, but nevertheless robust along their lines. And I was there in, after the fall. And the thing I noticed of, assuming it was a peak oil event, the thing that was going good after the fall were cigarettes, luxury cars, and maybe farming, in the sense that people were surviving on the farms. But anyways, my question is, have any of you experienced, maybe not the Soviet Union, but some other countries or some other situations, well, you've already kind of specified some, but of post-catastrophe type situations that where the kinds of things would do well in those situations?
I think the most of the events most commonly are political events, and hopefully we won't have one of those. You know, the French Revolution or whatever. One thing that, you know, what happened here in Houston between 1981 and 1986, from, you know, the high, we're the center of the universe, you know, $30 oil, to what did it get down to, $8 oil 5 years later. And there were lots of see-through buildings. There was a, you know, a general You know, the joke about, you know, what can a pigeon do that a Texas millionaire can't do, which is put a deposit down on a Mercedes. You know, there was a lot of that. So what are the, you know, it's hard to know, but I think one of the observations that I would have is that the sort of most highly refined skills in the old regime become fairly worthless in the new regime. So I'm not sure I'd want to be a hedge fund manager after the fall, but people still need to eat, people still need to get their clothes done, people still, you know, sort of those kinds of functions still happen. But, you know, but those people were poor to begin with, and they're slightly more poor afterwards. So, you know, I've been giving some thought to, you know, who prospers, who survives well, who survived well, you know, who were the relative winners in the United States between 1929 and 1935. If you can find a pattern, then that might be a pattern that you'd want to pay attention to.
You indicated you were in Russia prior to the fall, and then you were there after. Keep in mind that Russia's decline took roughly 4.5 million barrels of demand off the world market. Where would we be today in worldwide demand if the Soviet Union had not collapsed? We would not be sitting at 87, 88, so whatever the exact number is today. And as they come back, just to the baseline, I mean, that's an interesting one. I would recommend you go to the IEA and get the data on Russia and the former Soviet Union and run the numbers and just do a 2% growth number on that. And you realize that the fall of the Soviet Union saved our bacon. So, anyway.
One last question, and then we want to let you go because it is noon. Yes.
Question for the financial planners. What non-oil and gas-related energy investments are you putting your accounts into, for instance, coal, nuclear, or alternative energy? Any stocks, mutual funds, or ETFs that you'd recommend?
I'll go first, then you. Okay. I am in the coal market. The two that I own, and I personally own these, by the way, and I need to disclose that. I own BTU and Consol. I think Consol's a very, very well-run coal company. They're U.S.-based. Primarily Appalachian. They don't have much exposure to met coal. It's mostly thermal. BTU, the reason there is, of course, they're the largest player, but their moves to Australia, they know that the Chinese are going to buy coal. It is public policy in China that nuclear power is supplemental. They realize they cannot scale nuclear fast enough. The only solution is coal. They're going to go pedal the metal on it. Peabody has been, as you know, purchasing there. So I do own those two. As I indicated, most mutual funds and ETFs do not own or have very minimal exposure to coal. So you're going to have to look in the individual stock holdings to bring that into line. Okay. Now how that fits in for you personally, I know I have some individuals who will not own it. Mountaintop mining, you know, whatever you care to pick, it's against their conscience. For example, I won't own Altria no matter how good an investment idea it is. And then on the other side, the infrastructure, as Charlie had indicated, efficiencies and conservation, there's a lot of room to turn the lights off in this room. Someday we'll get to LED lighting. We're not there yet. I mean, but there's a lot of room to improve things. So you can look, as Brian King had mentioned, GE is a kind of a peak oil mutual fund to a degree. They have this baggage of finance going right now. That's a problem. But so I would look there. Look at your daily life. The best place is to look at your daily life and say, where's some place that I could take some energy use out of my life, and what company might do that? You know, kind of the Peter Lynch strategy, I guess, applied there. But I'll tell you right now, if you go to a traditional mutual fund investment, you will not find, you're going to have to build it yourself, a peak oil portfolio. Okay? You're going to have to build it yourself.
Sounds like an opportunity for you two guys to develop one and
yeah,
market it.
That's come up in this meeting more than once. So.
I think the other, I don't recommend individual stocks. I think that it's a full-time job, and I would rather, through mutual funds, hire people like Charlie. I mean, he doesn't run a fund, but there are people who do good work. There are 3 global natural resource funds that I use, which I'm not going to give you the names of because I'm not supposed to. But, you know, there are a number of global natural resource funds, usually about 2/3 energy, half to 2/3 energy, broadly diversified, including coal and some of the other things as well as oil. A year or two ago, they were probably 60% in Canada. They're less than that now because I think the prices have run up. but these are people that are doing it. And interestingly, the top 10, if you look at the list of the top 10 stocks of each of the 3 funds, there is one company that's owned by 2 of the funds. There's 29 different companies owned in the top 10 of the 3 funds. So by getting multiple managers, you're getting different viewpoints, different bullishness on the dollar, or different perspectives on things. And if I can get 2 smart people running my money or my clients' money instead of 1, that's better. So that's the approach that I take for my clients. And most of my clients have 10 to 15% in energy, energy and natural resources, in addition to the 8% they're going to pick up just by owning general purpose U.S. stock funds. So that's how I approach it. Because a good recommendation today in 60 days might be a lousy recommendation, and unless we're following it all the time, that's not a good use of my skills. So I would rather hire people who do follow it all the time, who have a good track record, and that's how I recommend my clients invest.
And remember the 90%, get the asset class right. You get that right, and you can mess up. It's like yesterday, Schlumberger got taken down over 10%. And if you were just in the oil and driller service companies, in the form of even an ETF, you lost 4%. So you diversified your risk into individual, but you got the asset right, okay? So I'm gonna see, that's where you spend your time. Spend 90% of your time where you're gonna get 90% of your return.
Spend 90% of your time outside playing.
Good point.
Spend 10% of what's left doing this stuff.
Thank you. All right. That concludes the program, and we do thank you for staying with us, and hopefully we'll see you next year. Thanks.